Welcome back to educator.com. Today we're going to go over the Federal Reserve and monetary policy. So let's get right into it here. All right, in today's lesson overview, we're just going to do a basic introduction to what the Federal Reserve does. So we're going to review the history and structure of the Federal Reserve System. We're going to describe some of the functions of the Federal Reserve. We're going to explain the three major tools of monetary policy. And then we're going to detail the role the Fed played during the financial crisis of 2008. So again, it's good to know. Some of this might not directly be tested on the AP exam, but again, the concepts will be here. And again, the three tools of the Fed is dealing with the reserve requirement, the discount rate, and open market operations. This is absolutely essential. I'm going to circle this here. When you take the AP Econ exam, know the three tools of monetary policy. If that's one thing I can emphasize, out of a 60-question multiple choice test, knowledge of the reserve requirement, discount rate, open market operations will at least get you 5 questions right if you've mastered it. So it's a very good investment of your time to watch this and rewatch this lecture if you have to. All right, so the history of the Federal Reserve Bank. In 1913, the Federal Reserve System was established. Woodrow Wilson signed it into law, and it survived American law for over 100 years. And kind of the reasoning behind this was the Panic of 1907. It really created this public atmosphere in which individuals were amenable to a federal banking system. There are a lot of these bank failures, and so you can argue that there's a lot of individuals that sought for more of a centralized banking system here. And so when the Federal Reserve was created, that's exactly what happened. The Fed created this monopoly of money supply in the United States, which again, in most countries today, you have this government controlling this money supply here. But one thing here that, again, the name is very misleading. It's a federal and reserve, when the reality is the Fed is really a private institution with a public component. It's really not a federal institution. So that's one mistake that a lot of people make. I would say if you did a poll, if maybe Jimmy Fallon did a poll and ask Americans what they think about the Federal Reserve and whether or not the government should give up control of this public institution, I think a lot of people would answer that and not realize that the Federal Reserve is not controlled by the government. It's a private institution. Now again, there's a public aspect to the Federal Reserve, but for the most part, it is a private institution. And it's this board of governors that sees the public aspect of the Federal Reserve. These 7 members who are appointed to 14-year terms by the president, and they're approved by the Senate. The chairs, on the other hand, are appointed to renewable 4-year terms. Again, recent news, Janet Yellen was appointed by President Barack Obama in 2014 in January to replace Ben Bernanke. So it's a historic event, first female chair of the Federal Reserve. So we can say that we've had a female chairman of the Fed before we've had a female president of the United States. So the Federal Reserve structure. So how does it work here? So you have 12 Federal Reserve banks, and they're each in charge of their district. Okay. So what happens is the following: they audit books of private sector banks to ensure that banks are financially sound. So they get the books and they audit it. They make sure that what's stated in there it reconciles with what's actually going on in the banks. Now, of the 12 banks, the New York Fed plays the special role of carrying out open market operations, which we'll discuss in detail a little bit later. But basically, the New York Fed, they're the head honcho of the 12 banks. So New York is rightly called the financial capital of the United States because a lot of important financial transactions actually take place in the New York Fed. Now, the Federal Open Market Committee, or commonly abbreviated as being the FOMC, they make decisions about monetary policy. And it's a combination of the board presidents and the board of governors. So the board of governors, so 7 of them, plus the New York Fed president, and then 4 rotating bank presidents of the 11 districts. They're the ones that make these huge decisions on monetary policy, the Federal Open Market Committee. So what are the functions of the Federal Reserve? So what do they actually do? Well, they provide financial services, and they supervise and regulate banking institutions. Now, what does that actually mean here? So if you dig down into it, providing financial services, they serve as this banker's bank, as well as the bank for the United States. So just like you might go and open up a checking account at Chase or Wells Fargo, well, the U.S. Bank, the United States Treasury, they bank with the Federal Reserve. So the government actually has a checking account with the Fed through the U.S. Treasury. Now, you can ask your congressman exactly how much is in that checking account. And you might be a little surprised by how much or how much isn't in the U.S. checking account. Another thing is they supervise and regulate banking institutions. So they're charged with ensuring the soundness of the nation's banking and financial system. And so both the district banks and the board of governors, they kind of share duties of overseeing, what's going on in terms of the banking sector. So other functions of the Federal Reserve include maintaining the stability of the financial system, and they conduct monetary policy, which is just to highlight here, this is the focus of AP Macroeconomics, monetary policy. Again, it's good to know the background and history, but that's not going to make a huge part of this course curriculum here. So the Federal Reserve, they provide liquidity to the system. They provide liquidity to financial institutions, and they provided a discount window for banks after the events of 9/11. So they serve to calm the markets and say that, terrorists they may have attacked, but they couldn't destroy the financial system. And so conducting monetary policy is actually this chief function of the Federal Reserve. So the Board of Governors, they use monetary policy tools to address the macroeconomic fluctuations that occur in the economy. So some people might argue that, fiscal policy is more important, but the standard view is that monetary policy, you can directly attack what's going on in the economy, whereas fiscal policy, well, you have the president and Congress, and there's a lot of compromise that takes place, whereas the Federal Reserve, through the FOMC, they can directly either raise the rates or lower the rates, and has more of a direct influence on the economy. So reserve requirements and the discount rate. So the Fed, they can adjust the reserve requirement and they can adjust the discount rate. Okay, so what exactly is this reserve requirement? Well, banks are required to hold on to 10% of its checkable bank deposits. So let's say a bank has $1 million worth of checkable bank deposits, of which they can lend out 90% of it, so they can lend out up to $900,000. So they can lend. They normally won't lend all of that, but they have the right to. And they must keep $100,000 or 10% as reserve. So this is the required reserve. So 10% ratio is what's required. Now, again, as a matter of practicality, the Fed will rarely change this rate. So the last change occurred in 1992. Usually when you're dealing with the reserve ratio, if you change that just has so many implications with the banking system that the Fed is very reluctant to change this. And if the money falls below, then the banks will borrow from other banks through what's called the federal funds market. And that's something that the Fed sets a target rate for, but again, so if for some reason, Bank of America lends out $900,000 and someone withdraws money and they don't have that $1 million, well, they have to kind of make up this amount that they have to keep in reserve. So Bank of America might borrow from Wells Fargo in the federal funds market. So the interest rate that banks borrow from other banks is the federal funds rate. And just, again, as a general mnemonic, or as a general rule of thumb, if the reserve ratio increases, then the money supply is going to decrease. That makes sense because the money supply has been constricted. Conversely, if the reserve ratio decreases, so banks have to hold on to less percentage, then the money supply is going to increase. That makes sense. If banks were required to hold on to 1% of the money, then 99% of the money that's been deposited would recirculate the economy, and the money supply, in theory, would go up by a whole lot. And the discount rate, the Fed can change that. Discount rate is the interest rate that the Fed charges directly. So rather than borrowing from another bank, if you borrow directly from the Federal Reserve, they're going to charge the discount rate. But again, this is rarely actually used to actively manage the money supply. Usually it's the federal funds rate. Usually it's the federal funds rate that the Fed is going to use to actively manage this money supply. So open market operations. So one of the questions that you're going to see on the AP exam is, what is the tool that the Fed uses in terms of open market operations to change the money supply? So you can't say change the discount rate or reserve ratio. They're looking for open market operations, which is basically either buying or selling of government securities. So the Fed will either buy or sell U.S. Treasury bills through a commercial bank. Okay, so when the Fed buys bonds, the money supply increases. So buying bonds will bloat the money supply. So buy will bloat, or the money supply will increase. MS will increase here. Conversely, when the Fed sells bonds, the money supply decreases. Sell would be shrink. So the MS actually decreases. So this is a mnemonic that I use. Sell, shrink, and buy, bloat. So if there's a recession going on and the Fed wants to stimulate more economic activity, then the Fed is going to buy bonds to bloat the money supply. If there's too much money floating around and the Fed wants to, stop economic activity and halt inflation, then they're going to sell bonds to try to shrink the money supply. And so that's kind of the mnemonic behind that. So again, selling bonds will shrink the money supply. Okay. Now, how does this actually happen in reality? So how does the Fed actually purchase U.S. Treasury bills from banks? Well, again, ultimately the Fed, they're going to create money that heretofore never existed, and they're going to put it into existence here. So remember, we have a fiat currency, so the federal government, they can actually create money. Now, what we don't do is we don't create money to pay off directly. Our way of creating money is a little bit more indirect than, let's say, Zimbabwe. We basically borrow money from ourselves. So the debt that is being created ultimately is not just money that's created out of thin air, so to speak, but we're borrowing money. So we're creating the money, but the idea that we owe that money at some unspecified time in the future, in theory again. So the financial crisis of 2008, what actually happened? To give you an idea, there was a lot of subprime lending that led to this housing bubble. What that means is that a lot of groups of individuals that really traditionally wouldn't have qualified for mortgages or fixed rate loans to borrow money to buy a house, they weren't getting it. So, but those that normally wouldn't qualify, they were just being approved. And what ended up happening, again, this ripple effect. Fed Chair Alan Greenspan, he was termed the maestro for guiding the economy through relative prosperity in the 1990s. I read the book, really praised Alan Greenspan for leading the United States through relatively low unemployment and low inflation. But his reputation really took a hit because these low interest rates, however, really helped cause a boom in housing, right? So maybe a house that was worth $300,000, let's say in 2003, suddenly became maybe not 800,000, let's say 750,000 in 2006 or 2007, the height of this financial bubble, right? And so what ended up happening is the subprime lending, people were were buying houses at these obscenely high prices. And, the increase in popularity, why not borrow? Even though I don't have the right credit, I can't afford it. But a lot of people just got greedy collectively. And so the housing boom busted, and people took out loans for $600,000, and the value of the house, maybe it was like $400,000 now. So people were upside down. A significant portion of the population owed more on their house than the actual value of their house. So this terminology being underwater really, had this ripple effect on the broader economy. And so the reason why a lot of these banks would take out these mortgages for unqualified customers, really, the mortgages were basically sold off and repackaged to other investors as loan-backed securities. So they didn't really care if the buyer defaulted on that loan, because they had already repackaged that and sold that off, and it wasn't really the concern of the original lender. And really, if you think about it, what really was the probability that large numbers of home buyers default on their payments at the same time? Well, the answer actually turns out there was a high probability, and it did happen, and we had the Great Recession of 2008. So what took place here? So in a nutshell, housing collapse led to a lot of non-bank banks becoming very vulnerable. So a lot of these non-traditional banks that were engaging in bank-like activities, they became very vulnerable. The Fed bailed out Bear Stearns and insurance giant AIG because they were deemed too big to fail. So the Fed actually stepped in and said, if these companies collapse, then the whole economy is going to go under. So we're going to lend them. Very unprecedented move at the time. And but in September 2008, though, the Fed, for some reason, did not intervene with Lehman Brothers, and so they were allowed to fail. And within days, there was this widespread panic in the financial system. Well, if Lehman Brothers falls, then other institutions are going to fall, and it really created this panic, and had a very profound effect on our financial markets up through the following year. The Dow was dropping 300, 400 points a day. So a lot of people saw this housing collapse as being something that led to greater misfortunes in the economy. So the Fed, they've had to resort to quantitative easing, because these conventional monetary policy of lowering the federal funds rate or lowering the discount rate, dealing with government securities, it simply cannot be used anymore, because our federal funds rate, target federal funds rate, has dropped down to 0%. So again, QE1 injected over $2 trillion into banks. QE2 put in $600 billion. And the Fed has continued with QE2 by buying back government debt, mortgage-backed securities, and other assets. So the Fed, they've announced that they're going to kind of ease down. They're going to ease off of this expansionary monetary policy. But that's kind of the response that the Fed has made in terms of trying to stimulate the economy by basically injecting more money into the banks and therefore the money supply. So example number one, which of the following is not a role of the Federal Reserve System? So what are the things the Federal Reserve does? So I'm going to put a check mark next to the things the Federal Reserve does, and the answer is the one thing that the Federal Reserve does not do. Does it control monetary policy? Absolutely. Fiscal policy? That's controlled by Congress and the President. So that's going to be the answer, but let's look at the other choices. Setting a target federal funds rate? Yes, they do that through the FOMC. Do they supervise and regulate banks? Absolutely. Do they determine the required reserve ratio? Absolutely. So the correct answer is going to be B. They don't control fiscal policy. Example number two, when the Fed makes a loan to a commercial bank, it charges what rate? No interest? Absolutely not. Very rarely are you going to get no interest loans. Once in a while, it's a great loan for the borrower. The federal funds rate, that sounds like the right answer, but remember, the federal funds rate is the rate at which banks borrow from each other in the federal funds market. Discount rate, that seems like the correct answer, so we put a check mark. prime rate is the best rate, is like the rate that banks charge their best customers. Fixed interest rate of 10%, that would be incorrect. So the correct answer is C, discount rate. Okay, question number 3, example number 3 here. So if the Fed purchases U.S. Treasury bills from a commercial bank, what happens to bank reserves and the money supply? So remember, just use this mnemonic here. Buy government securities equals bloat money supply. So the MS is going to increase here. Now, to give you an idea here, I know it's going to be introduced later on here, but let me draw you the money market graph here. So here's the quantity of money, and here's the nominal interest rate. And you have the money demand right here, and you're going to have the money supply. Let's make it green because supply of money is green. So MS1. Okay, so this is going to be the interest rate here, and here's going to be the quantity of money here. So when the Fed bloats the money supply, when it buys government securities, the MS, the money supply curve, is going to shift to the right. MS2, which is a vertical line, it shifts to the right here. The interest rate is going to decrease from R1 to R2 and Q2 here. So there's going to be an increase in money supply at a lower interest rate. Now, if I want to get even more connected with the graphs, the aggregate demand curve, so Y or RGDP, with the lower interest rate here, so you have the aggregate demand, and let's say this is a recessionary period here, so this is the LRAS, and here's the price level. So originally you start off with Y1, and this is PL1. What is buying government securities going to do? It's going to lower interest rates. So what ends up happening, Y equals C plus I plus G plus NX. Investment and consumer expenditures go up. Y goes up. As a result, aggregate demand increases to the right, AD2. The real GDP increases, and the price level also increases here. So the answer, what happens to bank reserves and what happens to the money supply? They both increase. Yeah, I gave you a whole lot more than was required to answer this, but hopefully you see the connection between the money supply, the money market graph, the macroeconomic equation, and then the aggregate supply and aggregate demand. So if you see the connection, it's going to definitely work out in your favor. Final example, what are the 3 traditional tools of monetary policy used by the Fed? Which method is preferred? So there are 3 tools here. One is going to be the discount rate. Okay, 2 is going to be the required reserve ratio. And 3 is going to be open market operations. Okay, so to give you an idea here, discount rate is the rate that banks charge or are charged directly by the Fed. So raising the discount rate will lower money supply, whereas lowering the discount rate raises the money supply. Okay, required reserve ratio, again, it's roughly, it's at that 10% here, but raising the RRR will again lower the MS because banks are going to be required to hold on to more of their money, so there's less money out there for the people. And when you lower the RRR, sound like a seal, RRR, when you lower the RRR, it raises the money supply. Why? Because now banks are going to be able to lend out more of their reserves, and therefore it's going to increase the money supply. And then open market operations. This is the preferred method. Okay, why? Because it deals with more of the supply and demand here. Buying government securities will increase the money supply. So buying, again, will bloat the money supply, bloat. And then selling government securities will decrease the money supply. Why? Because sell is going to shrink the money supply. So sell, shrink. Okay. So these are the three traditional tools of monetary policy. Thank you for watching Educator.com.